Welcome to another video. This video would be about solving a question related to tax allowable depreciation. We discussed the concept of tax allowable depreciation in our previous video. Now we are going to I'm going to show you how to calculate the tax allowable depreciation each year and how to calculate the associated tax savings flows that will finally be included in your NPV calculation. Let's read the question. The question is, a company purchases machinery for 8,000 for use in a project with a 4-year life. So the duration of the investment is 4 year and the cost of the asset is $8,000. The corporation tax rate is 28% and the tax payments are made 1 year in arrears, meaning 1 year later. Tax allowable depreciation follows the 25% reducing balance method. So the method used is has been mentioned and the depreciation rate is mentioned. Then it is saying that with a balancing adjustment in the year of disposal. So remember that in the final year or in the year of sale, there is no tax allowable depreciation, but rather a balancing allowance or balancing charge is calculated. So how to do it, I will show you. Then there's the requirement. What is the requirement? Forecast the tax savings cash flows to be included in net present value if residual value is 2000 and the case 2 is residual value is 3500. So let's do the first part. So suppose you were solving you were calculating NPV and now you have to do the working for the tax allowable depreciation. So suppose your answer of NPV was in this row and your recommendation you wrote in the next row. So your working would be below this. So we will write it as working. We will place the heading on top of it. So working tax for tax allowable depreciation. So this is the name of our working. This is the heading for our working, and of course it is a heading. So I will increase its size and increase the adjust the row height accordingly. Now the next thing we are going to do is that we are going to copy the years from our NPV calculation here, and also the heading of the figure of the rounded figures. So now, whenever you are going to do the working for the tax allowable depreciation, on the first line you will write this tax written down value. Now, what is the tax written down value? Very easy concept. This is the tax equivalent of the accounting's net book value. You must remember the concept of net book value in accounting. It was the value of the asset that is shown in the account in the books in our books of accounts, right? So a net book value is the value of the asset that is being shown in our books. So tax return on value is the same concept as the net book value, but the only difference is in accounting you have net book value, in tax you have the tax return down value. So the same concept applies, calculation is same, concept is same, just the name is different. So tax return down value, you can also read it as net book value, no problem. But you must write it as tax return down value because this is the thing is name is just different, the concept is same. Then in the row below it, you will write tax allowable depreciation. So let's write the tax return on value for year zero. Today, when we purchase the asset, what should be the net book value for that asset? It should be equal to 8,000, which is the cost of the asset. So of course, because no depreciation has been charged, so tax return on value would be equal to $8,000. Let me just make this look in the middle and add this two decimal places. So tax return on value at year zero would be equal to $8,000. Then tax allowable depreciation, how to calculate this using reducing balance method. So this is assumed knowledge from your previous studies. So I'm writing the formulas here for reducing balance method. If the reducing balance method, if you have to solve the question using reducing balance method, the annual depreciation would be equal to opening net book value in the case of accounting, and in the case of taxation, it would be tax return on value, TWDV, multiply by percentage, the percentage depreciation percentage that would be given in question. So annual depreciation is calculated like this when the reducing balance method is used. If straight line method is being used, then the calculation of annual depreciation is equal to cost multiplied by multiplied by depreciation percentage. Or there is another formula for straight line method, and for annual depreciation it is um, cost minus residual value divided by useful life, right? So yeah, so this is the formula for straight line method for annual depreciation. Now let's calculate the tax allowable depreciation using the reducing balance method, because the reducing balance method is given in the question. So here it is written 25%. We are going to use 25% reducing balance method. So the tax allowable depreciation for year 1 would be opening tax written on value is 8,000, or opening net book value is equal to 8,000 multiplied by 25%. So this is the tax allowable depreciation in year 1, 2000. Now, what would be the tax written on value after year 1? It would be equal to 8,000 minus 2,000, because it was 8,000 at the start of the year, minus 2,000 depreciation has been charged. So tax return on value has been reduced to 6,000. So this is the same concept applies as the net book value. If we were calculating net book value, the same calculation we would be doing. So tax allowable depreciation, what would be the tax allowable depreciation in year 2? You can just copy paste the formula. So it would be equal to 1.5. How? 6,000 is the opening tax return on value multiplied by depreciation percentage, which is 25%. So 1.5 thousand. And then what would be the tax return on value after year 2? We can copy paste this formula. So it will be equal to 4.5 thousand. How? 6,000 was the opening value, and minus 1.5 thousand, which was which was this year's depreciation charge. So after 2 years, the tax return on value of the asset would be equal to 4.5 thousand, right? Now, what would be the tax allowable depreciation for year 3? It would be equal to this figure. I've just copy pasted the previous formula. So 415,000 multiplied by 25%. Opening opening value multiplied by 25%, because reducing balance method is being used. Now, what would be the tax return on value after year 3? It would be equal to this figure. Copy pasted the formula before it. So 4.5 minus 1.13. So opening value minus depreciation charge for this year. So even if I just delete these formulas and just copy paste these formulas, the answer will be the same, right? So you just need to create the right formula in the first cells, and you can copy paste that formula to the following cells. But you cannot paste the same formula in the last cell, in the last year. Why? Because in the last year, a different concept applies. What is the different concept? On the last year, you must remember the tax written down value is equal to residual value. What have I said? I'm repeating it. In the year of sale, or in the last year of your investment, the tax written down value is equal to the residual value. What is the residual value? Let's see. It is equal to 2,000. So tax written down value would be equal to 2,000 at the last year. So tax written down value is calculated differently in the last year. Also, the tax allowable depreciation is also calculated differently in the last year, because in the last year there is no tax allowable depreciation. There is a balancing allowance or balancing charge. Let's read this point. On the final year of sale, there is no tax allowable depreciation, but rather a balancing allowance or balancing charge. So what is the balancing allowance or balancing charge? How it is calculated? Balancing allowance or balancing charge is calculated as opening tax return down value minus residual value. So very simple formula: opening tax return down value minus residual value. So let's calculate it. Opening net book value or opening tax return down value, what it is? It is 3.38 minus the residual value, what it is? 2,000. So this is the balancing allowance. Why is it balancing allowance and not balancing charge? Because if you use this formula and the answer comes as a positive figure, then it is a balancing allowance, and if the answer comes as a negative figure, then it is balancing charge. So if this 1.38 had been a negative figure, we would have said that this is a balancing charge. So 1.38 is not tax allowable depreciation, but rather it is a balancing allowance. So you just remember this, that in the final year the tax written down value is equal to residual value, and tax allowable depreciation is equal to opening net book value 3.38 minus the residual value. You are always going to do your calculation like this, so it becomes just very much easy. Now we have to write the final answers that we are going to include in our NPV calculation, and that is tax savings cash flows. What are the tax savings cash flows? So tax is paid 1 year in arrears. So of course, if after year one we were allowed to deduct another further allowed expense of 2000, which was known as TAD. So we were allowed to deduct another further expense which was TAD of 2000. So this will reduce year one's taxable profit and our tax calculated. But we are paying the tax 1 year later, right? So the benefit of that will be received after 2 years. So 2000 multiplied by 28%, which is the taxation rate. Here it is shown that the taxation rate is 28%. So multiply 28%. So I will write this in the below in the year two, and then I can copy paste this here. Let's just remove this. So what would be the tax savings cash flows in year three? It would be 115 multiplied by 28%. Similarly, in year five, it would be 1138 multiplied by 28%. So if the tax was paid immediately, then the working would have looked like this, just this difference. So very small, very minor difference. If the tax is paid 1 year later, then you just take your cash flows 1 year later, 1 year further. That is all. So very easy working. You just needs to be hands to get hands on with it. The working is very simple. The most of the working is just copy pasting, right? So you just need to create a right formula in the first cells and then copy paste to the following cells. The only different exception is the last year tax written down value is equivalent to residual value, is equal to residual value, and last year's tax allowable depreciation is equal to opening tax written down value minus residual value. So I hope it is clear. Now let's do the second part. So I can just copy paste the headings, and then let's start this again from scratch. So tax written down value. On the first line, you have to write the tax written down value, which is the accounting equivalent of which is the tax equivalent of accounting's net book value. So what is the net book value at year zero or today? It is equal to 8000. So I will write 8 here. Let me make this figure look in the middle and add decimal to decimal places. Now in the second row, you will calculate the tax allowable depreciation. How will this be calculated? Using the reducing balance method, you calculate tax allowable depreciation as opening value, opening tax written down value multiplied by depreciation percentage, which is 25%. Now the year one's tax written down value would be 8000 minus 2000, 6000. You just copy paste these formulas to the following cells and check whether it has worked fine. So 4.5 multiplied by 25% in the last cell. Yeah, 4.5 is what? This must be the opening tax written down value. So let's see how 4.5 has been calculated. 6000 minus 1.5 thousand, that year's depreciation charge. So yeah, we have calculated our figures correctly. Now in the year 4, I told you that there is a difference in calculation. So tax written down value in the year of sale is equal to the residual value, which is 3.5 thousand. And then the tax allowable depreciation is equal to opening tax written down value minus residual value. So now see, note that the figure is now coming as a negative figure. Tax allowable depreciation, the year's 4 figure is coming as a negative figure. So this is what? This is a balancing charge, right? Because in the previous question, the figure was a positive figure, 1138. In this case, the figure is a negative figure, so means this is a balancing charge. So now let's do the tax savings cash flows. So 2 multiplied by 28%, the corporation tax rate, and then copy paste to the following cells. You see tax savings cash flow is also showing as a negative figure, which is correct because of course the figure was in itself the negative. So of course we didn't saved any tax, but rather paid we needed to pay additional tax. So this is all. This is the tax saving cash flows that you need to include in your NPV calculation when you are calculating your NPV. So if the residual value was 2000, then we needed to include these cash flows. If the residual value was 3500, we needed to include these cash flows in our NPV calculation. So this was all. And now I've created a workbook for you guys which have practice questions in it. Let me open it. So this is the workbook that I have created. I will attach this in the description of the video. So um, this is a self-marking workbook, meaning that you cannot fill on any other cell, but you can only fill the blue colored cells. You can also write in these cells. It will automatically mark whether your answer is correct or not. So very good for practicing. So the first question is very similar to the one that I have just attempted on the practice platform. The question 2 is different. I will talk about question 2 and 3 in the next video. So bye. We'll meet in the next video. Bye.